Welcome to Volume 5, Issue number 3 of the Milestone Investing newsletter. And this week's ex-dividend date is the 17th of January 2019. Let's look at Compass Group. Compass Group PLC provides food and support services. The company's segments include North America, Europe, rest of the world, and central activities. The Europe segment includes Turkey and Russia. Rest of the world includes Japan. The company delivers services in sectors including business and industry, healthcare and seniors, education, defense, offshore and remote, and sports and leisure. The company offers its services to customers in the workplace, schools and colleges, hospitals at leisure and in remote environments. It provides breakfasts, lunches, and dinners, and also offers hospitality services. The company offers a range of support services including cleaning, building operations and maintenance, business and office services, logistics and transport, outdoor project management and security. Its food service offerings under healthcare and seniors sector include patient feeding, retail food courts, hospitality, catering, vending, retail shops, and staff restaurants. Dominic Blakemore is the CEO and Johnny Thompson is the Director of Finance, CFO. They're number 17 in the FTSE 100 with a valuation of 25.6 billion. Okay, this company, had you been trading this company in the last 8 years for its dividends, and they pay dividends twice a year, you have had 18 opportunities to trade this company. 11 times out of 18, which is 61% of the time. Had you gone long, you'd have gotten your money back within 1 week. 6 times out of 18, which is 33% of the time, it would have taken you more than a week, but less than a month to get your money back. The range here is between 8 days and 30 days. And once, it would have taken you more than 30 days to get your money back, and that's 6% of the time. And that in that one case, it was 111 days. And that's Compass on the long side. On the short side, had you traded this company and gone short, taking advantage of the drop, the immediate drop that comes after paying dividends, 8 times out of 18, which is 44% of the time, you would have made money on day 1. The return on investment would have been anywhere between 1% and 33%. And in fact, 2 of those numbers out of the 8, 2 are double digits, and the other 6 are single digit numbers. Okay. And 7 times out of 18, which is 39% of the time, you would have made money on day 2, and that's 39% of the time. And the return on investment would have been anywhere between 1% and 40%. And on day 2, 3 of the 7 are double-digit numbers, and 4 of the 7 is single-digit numbers. Let's look at their fundamentals. 2014, 17 billion. 2015, 17.6 billion. 2016, 19.6. 2017, 22.6. 2018, 22.9 or 23 billion. So basically, their revenue streams are marching upwards in a nice upward trend, which is what we want to see, ideally. Their profits, 1.1 billion. Then it goes to 1.2 billion. Then it goes to 1.3 billion, up to 1.6 billion, and down to 1.5. So here, the profits are down 40 million compared 2018 to 2017. And because they made more money and the profits are down, that means their margins would have been softened and it's gone down. So if you look at this here, in fact, their numbers are really quite consistent actually. So they're obviously managing their costs quite well. So again, if you look at the margins, you've got 6.7%, which means every £100, 670 went down to profit, 660 went to profit here, 670 profit here, 690 to profit here, 660 to profit here. Okay, and this, by the way, profit margin is a performance indicator. And so if you want to know how people are managing their business, this number right here is what management inside the company, as well as investors outside the company, they look at this number to see how well they're managing their costs relative to their revenue streams. And if you keep your costs under control, then you're going to be doing quite well. We said for Compass that they're going to be paying out £404 billion. They have made here 1.1 billion. So again, easily affordable. And they've got 900 billion in the bank. So again, they can afford that, not a problem. P ratio here, you've got 19, then 21, 19, 20, 21. They're pretty stable. Their P ratio is pretty stable. Unlike what we saw with the other one, this one's pretty stable. Now, remember I told you, if you take 100 and divide it by the P ratio, you get a number. So this is equivalent to 5%, 5%, 5%, 5%, and 5%. So basically, this company is a 5%er for you. And it's been consistent for the last 5 years at a range of 5%, okay? So what does that mean? It means if you chuck money at this company and just hold the stock, you can expect the company to give you 5% return on your money next year. That's basically what it means. Now, it doesn't mean next year will be the same as the previous years, but that's kind of what they're doing. They're generating for you a 5% return on your investment if you just bought it and held it. That's kind of how I like to look at that number. Let me summarize what I've just said. Compass has a better track record of rewarding long traders than short traders in the last 8 years. So that's the performance of the companies this week. So if you want to go short, you might want to look here, where it's highlighted. And if you want to go long this week, you might want to look here, okay? This is Miles from Milestone Investing. I want to give you an update on the Compass Group. They were paying a 25.4p dividend and the yield is approximately 1.5%. So that basically meant that if you were a professional, you would be getting 20.3% if you were a professional. And if you're a non-professional, 7.6%. And so let's have a look how they did. Well, we can see that they were in this range between the green line and the red line on the day before the ex-dividend date. Then they went ex-dividend on the 17th of January. And then essentially, you've got the dividend adjustment here, you've got the milestone adjustment here. And so what does it do? It gaps down to the dividend adjustment, and then which is basically acting as support. And then it starts to trickle up a little bit. And then it comes back down again. And it goes, hits the milestone adjustment and bounces off. And then on the Monday, the 20th of January, it goes below that, okay? And then essentially the fall was over. From here, the 29th of January, it starts to move up slowly. Keeps on going up, keeps on going up, keeps on going up. And then eventually on the 5th of February, 2019, it actually hits the highest point pre-ex-dividend date. So it returns back to its old trading range. That takes approximately 3 weeks to do that whole journey. And that was on the Tuesday. Now, let's see what happened on had you left it for a few more days, because you could have technically 3 weeks later, you got your money back. But what happens? By the Thursday, you get this massive jump and effectively jumps up 6.8%. And if you were a professional, you're talking about this going from the highest point to here, more than a 100% increase, capital gain, as well as the 20% dividend. And that took basically 3 weeks for all of that to happen. So the question a lot of people ask me is, what would you do when it goes below the milestone adjustment? The thing is, you've got to hedge it. And here's the play. When you see that it's not wanting to behave itself on the upside, you just basically put in a hedge. And so because you're already long, you're then going to go short to make sure any downside doesn't cause an attrition of your funds, right? You don't want it to be giving you a loss as it falls, because you know it's going to run out of steam at some point. So you just hedge it. And then once it runs out of downside momentum, you close out that short, which is your hedge, and you let it rise. And then basically, so you wouldn't, obviously you don't know it's going to do it here. But when you see that it starts to rise, once it go back up again, you get rid of your short. And then basically let it just do its thing, because it is eventually going to go back up again. Now, what gives me the confidence it should go back up again? And it's to do with how you value companies and what the valuation comes from. Now, this valuation is obviously based on something, and the key to this is in the fundamental analysis. Now, a lot of traders only learn technical analysis, and technical analysis can only take you so far. Fundamental analysis is what's necessary to understand the key, and it's fundamental analysis that's the key to understanding why shares behave the way they do. So here's what's going on. All companies have a trading range, and the valuation is based on earnings times the P ratio. Earnings times the P ratio. Now, the P ratio, unfortunately, is a variable number, so this can change as well, but that's the formula nonetheless. And so there is going to be a PE ratio range, so that kind of gives you some tolerance as the range as to what it can do. But here's the point. When a company goes ex-dividend, you're adjusting for the dividend. But here's the problem. The dividend adjustment is not part of the valuation of a company. And so eventually it's going to go back to dividend times P ratio. So once this adjustment takes place, the share price can go back to where it started, because it's valued, the share price is valued at the earnings times P ratio. So as long as the company's earnings are increasing over time, it has to go back up. If the earnings are going down, different story. But if the earnings are going up, the share price will eventually go up. And that's what causes this ridiculous movement of down move and up move. The earnings is based on profits, not based on cash flow. But this adjustment is a cash flow adjustment because you're paying out dividends. And this comes from the balance sheet. And the profits is in the profit and loss statement. And when you've got earnings based on that, you've got earnings times P ratio. This is the valuation that is supporting the share price. Then you get this adjustment for dividends. Then you get this milestone adjustment. And then it falls some more. And then it starts to go back to the valuation it was always at and is always going to be. Now, if the profits or the earnings are going to be better than the previous year, you're going to find the share price going up, because it can be based on earnings times P ratio. I hope you find that useful. If you like this video, remember to press the like button and subscribe. This is Miles from Milestone Investing. Happy trading.